Hi, this is Thierry Samlal from PMML. Today I want to talk to you about the market statistics for multifamily buildings in the province of Quebec for the month of February 2024. So we're in a context now where the interest rates are showing a lot of stability. The market appreciates that. The investors are now back on the saddle, basically. We're seeing owners that decided not to put their multifamily assets for sale in 2023 because they didn't have confidence in the market. They thought they would not get their price. We're seeing those property owners coming back on the market now. I could tell you that the quantity of brokerage contracts that are signed at PMML are at a very high amount, and that we have requests for updating the assessments that we did last year that for properties that did not come out on the market. That's one thing. So we're feeling that the owners do have a lot of confidence in today's market because of the interest rates seem to be really stable right now. And with the comparables that were sold recently and in 2023, we could see that the market has pretty much been maintained in almost totality. There was some price drops, but nothing that is important enough to counterbalance and drop the market values. Also, we're seeing, we saw at the last quarter of 2023 an extreme amount of financing and refinancing volume. The financing and refinancing volume in dollars was 4 times the amount of transaction in dollars at the last quarter. Meaning that there's a lot of equity that was pulled out of the market and a lot of cash was available. A lot of people thought that cash was going to be king last year and that that they would be able to buy transactions way below market value. But that was not the case because the owners could hold on to their multifamily buildings and put them for sale way further down in time. So market confidence. A lot of volume right now. We have an extreme amount of accepted offers also at PMML. So even in a context where interest rates are high, equity creation over time is low with the payment of the mortgages, cash on cash is low, we're feeling that the buyers have found their comfort zone in the context, are now accepting the fact that real estate and brick and wood and concrete and steel is the way to put the money aside and to create much more value over time than just going to financial market. So that's what I'm hearing from investors. A lot of investors went on the financial market temporarily, but now are coming back to the real estate. And we could see it in the sales volumes and in the comparables that I'm going to talk to you about today on the market. So a context where there's a lot of comfort. Also, at the end of 2023, we've seen a lot of land sales taking place, showing that there's going to be a lot of development that is probably going to be coming out of the ground vertically in probably 2026, all across the province, but of course in the major cities first. So let's get down to brass tacks. I want to talk to you about, first of all, a major transaction in Côte-Saint-Luc. Côte-Saint-Luc, the western part of Montreal, always has been very popular with the REITs and the private investment funds. First of all, why? Because that's where the larger assets in Montreal were built, outside of the downtown core. And that's where originally there was a lot of English-speaking tenants, so it was attractive for operators and also for property owners that were from outside of Montreal to purchase in an English-speaking area, much more easy to manage and much more easy to comprehend for their ground teams, basically. So this transaction was done by a private group. We're talking about 5 buildings, 1970, 1971 construction, ranging between 40 to 48 units. So 223 units in total, concrete. Interesting to see that the average price per door here, when you're looking at the whole portfolio, it went for $206,000 per door. So that really comes and confirms and maintains property value in that area. And knowing this category of buyer, I do think that there's going to be optimization on the short term. And I do think that there's a projection that the value is going to greatly increase in that area I'm estimating about probably 20% over time if I go into the mindset of that buyer. So interesting to see that major sale of buildings which are pretty good, in good shape from the outside, shows that there's optimization still possible in that area. Shows that area is still largely in demand. And these 5 comparables, what's going to happen here is these 5 comparables are going to go into the database of chartered evaluators, of brokers, of banks, etc., and are now going to become the new comparables that we're going to be using to do our assessments, right? In 2023, the sales volume crashed a lot, but the sales that took place were still on the high range. And all of these assets that were sold in 2023, 2024 are going to become the new comparables. In 2023, we were using comparables of 2022 with lower interest rates. And because of that, a lot of people thought that the building values would change, but now this is not the case. So interesting to see that these new comparables are going to be part now for the next few months of what we're going to be using for assessment values to compare for other buildings to be sold in that area. So that's the western part of Montreal, always been very popular. On the eastern part of Montreal, not that many high-rises that have been built, but the ones that have been built usually are built on Sherbrooke Street. And this one here sold on Sherbrooke Street East, not too far from the Olympic Stadium, not too far from the P9 metro station, but still there's another Deschambly metro station which is close by. Schools are there. There's a CEGEP there. This is a high-rise, 96 units, 1966 construction. The main floor is commercial. The top floor is our residential. A mix of different unit sizes. And here we're talking about $156,000 per door. So not too long ago, a couple of years back, we were at an average of $130,000 per door for this type of asset. $156,000 makes sense. It's probably a little bit lower than market par, but it depends on the revenues expenses. So that being said, one of those concrete assets. Now I understand the buyer. This buyer was initially at the beginning of his career buying smaller assets, 6 plexes, etc. He's coming from the medical pharmaceutical field, and of course has a large level of contacts in that field. And we know that people in that field have to invest money to be able to have, for fiscal reasons, good conditions in their income tax reports, etc. So congratulations to this buyer for the conversion and going up into these larger size assets. I think it was only natural for him to go in that direction. Let's go to Sherbrooke City. Sherbrooke City, I was looking at the comparables in Sherbrooke City, and the prices per door vary between $57,000 per door all the way up to about $130,000 per door on average. But what I'm noticing, and the reason why there's such a large spectrum of value there in pricing, is because there's a lot of older assets in Sherbrooke, and there's a lot of assets that were not maintained in Sherbrooke and that have been detained by the same owners for decades and now are being sold. So there's a change of hand in Sherbrooke right now. The average market is about $110,000, $115,000 per door. But what I'm noticing here is that the buildings that are sold below $100,000 have very, very high caps. 3.5 to like 4, basically, below 100,000. Meaning what? And this is why I always tell my buyers, don't shop for a cap rate. If you're shopping for a cap rate and you have cash down, you're not necessarily going in the right direction, because the cap rate always has to be looked at in conjunction with the price per door. Why? Because a very, very low cap probably means there's a lot of potential of increasing the rents in the building, and meaning that often you could buy at a lower price per door. So if the price per door is lower and the cap rate is lower, meaning there's less return in your cap rate, that means there's a lot of potential in your asset. So that has to be looked at altogether. This one here sold at a nice average $98,000 per door, which is, for me, a good price. 1976 construction, 2 times 30 plexes, so a total of 60 doors. Technically this pricing should have been maybe $105,000 per door, but there's always particular conditions in a file. and this one went for about 100,000 per door, and the cap rate 4.2. So what does that mean? Probably that there was already some renovations, already some increase in value in rents, and there was still potential in the asset. Congratulations to the buyer. I do think that that's a great transaction for 60 doors. There's some volume. The owner probably came out of there being really happy with what he had, and we're talking about 4.2 cap. Saint-Foy, Quebec City. For those who know, Saint-Foy is when you're driving up from Two Rivers and coming from Montreal, going into Quebec City on the North Shore, you're going to choose Saint-Foy first. Okay, so Saint-Foy has been in competition for the last few months with Lévis across the river. A lot of new construction taking place there. There was an issue at Lévis. A lot of people were saying, well, the infrastructure in Lévis cannot take the newer buildings as far as sewage systems and water supply, etc., and infrastructure. But now we see that that problem does not exist for the moment. Lévis is in competition with Saint-Foy. But Saint-Foy is an interesting market because it's on the North Shore. It has certain proximity. You don't have to cross the bridge to go into to Quebec City. And it can be done like by walking distance if you want, or bike right into to downtown to the old city of Quebec, old portion of the city of Quebec. So 2 buildings, 129 unit, 126 unit. One sold close to 150 per door. The other one sold close to 200,000 per door. If you mix those two together, you're coming up to about, in this case, about 172,000 per door, which is an average. Now, why did we go there with this asset? Well, probably because for fiscal reasons, it was probably more interesting for either a seller or the buyer to have more or less value on one building. So that's why they split it that way. But when you're looking at the final average, we're talking about 172,000 per door. So Quebec City still on the map. Notice that up to now, all of the comparables I've gave you have met market standards or are slightly above. So meaning that there's a lot of market confidence. Market is real stable. Multifamily is a stable market with still a lot of potential of increase. And that is due to the fact that a lot of buyers are back on the market. We pulled out a lot of equity of multifamily. People are ready to re-inject. Last year we had a large increase in rental potential based on the Tribunal Administratif du Logement. This year also, I'm estimating that next year also. Of course, I don't have the crystal ball, but normally next year we should have an increase that resembles this year, technically. So that's what is maintaining the values right now. Let's go back into Montreal, Ville-Marie, close to the Jacques-Cartier Bridge, Papineau, walking distance to, biking to distance to Montreal, walking distance to the metro station, close to the Preval Esplanade Cartier redevelopment project, not too far from Quartier des Lumières, which is Radio-Canada and the old Molson plant redevelopment district. We're talking about a 2017 construction. 2017 construction, there's a couple of buildings that were built in 2017, 2018, and some of the value of those buildings have been doubled over time, which is incredible considering that the asset is pretty new, but 2017 is still very acceptable as being a new asset for the market. And here we have an asset that sold for close to $300,000 per door at a cap rate of 4.2. 4.2, newer builds in Montreal were going somewhere between 4.1 and 4.5 in average. This one went for 4.2, so it's right into the market. An appreciable price per door, but a very, very well located building. And it's in a strip of buildings being built right now. And an area being developed vertically, I should say, if I could say it that way. So buildings being demolished and buildings being built, and pretty close to downtown core. My last asset I want to talk to you about, Granby, 30 units, 1972 construction, sold for close to $98,000 per door at a cap rate which is below 3. So that, I just want to demonstrate here that, once again, it's not because your cap rate is compressed, so closer down to 3, that you're buying an asset that's not worth it. You always have to compute that cap rate in relationship with the price per door you're paying and the potential of the asset. So I hope this information was useful for you. You could go check out our PMML.ca website. I'm always available to answer all of your questions. Just give me a quick phone call or send me an email, and I'll be glad to answer your questions. We'll see you next month, and from there on, best of luck with all of your real estate adventures. Take care.